Ever wondered what the difference between IFRS for SME and LSE is? Well, today's conversation is dedicated to unraveling this very puzzle. The world of accounting is a vast and intricate one, and within it, terms like IFRS for SMEs and LSEs hold significant importance. You see, when we talk about IFRS, we're referring to the International Financial Reporting Standards, a globally recognized set of accounting principles. And when we add SMEs or LSEs to the mix, we're talking about these principles as they apply to small and medium-sized entities or large-sized entities respectively. Each has its unique set of rules, regulations, and exceptions tailored to their size and the complexity of their operations. Understanding these differences is not only crucial for accounting professionals, but also for business owners, investors, and even students. So, stay tuned as we dive deeper into the world of IFRS for SME and LSE. So, what exactly is an SME? It's a question that may seem rudimentary, but it's vital to understand the basics before we delve deeper. SME, or small and medium-sized entities, is a term that encompasses a vast array of businesses. But how do we differentiate them from larger entities? Let's break it down. At their core, SMEs are often small businesses. This could mean a corner bakery run by a family, a tech startup spearheaded by a young entrepreneur, or a local grocery store that's been serving the community for years. The common thread here is that these businesses are often managed by the owner or a family, giving them a distinct flavor of personal touch and commitment. But it's not just their size or ownership that defines them. The financial aspect also plays a pivotal role. SMEs typically have limited financial reserves. This means their revenue and expenses are comparatively smaller than those of larger entities. So, if you're looking at a company's financial statements and the numbers seem modest, you might be looking at an SME. Another characteristic of SMEs is the nature of their transactions. They usually engage in less complex transactions compared to larger entities. If you're an accounting student, you'll find that the measurements used for these transactions are less intricate, making them easier to understand and navigate. Now, it's important to note that not every small business qualifies as an SME. There are specific criteria that must be met, often related to the number of employees, annual turnover, and balance sheet total. These thresholds vary across different regions and industries, but they provide a clear framework for defining SMEs. In summary, SMEs are small to medium-sized businesses. They are often owner-managed with limited financial reserves and engage in less complex transactions. They are defined by specific criteria, including the size of their workforce, their annual turnover, and their balance sheet total. Now that we've defined SMEs, let's move on to their larger counterparts. Now, let's turn our focus to LSEs, or large-size entities. The world of business isn't just about small organizations. Large-size entities, or LSEs, make up a considerable portion of the global economy. They are typically publicly traded companies with substantial market values and numerous shareholders. These entities are typically more complex than SMEs, both in terms of their operational scope and the transactions they engage in. LSEs usually have a wider geographical presence, often operating in multiple countries or regions. This international scope can lead to more complex regulatory and reporting requirements. In contrast to SMEs, they are not usually owned or managed by a single individual or family, but are overseen by a board of directors representing the interests of numerous shareholders. These entities have significant financial reserves, and their revenue and expenses are usually far larger than those of SMEs. They also employ a large workforce, often numbering in the thousands or even tens of thousands. One of the significant differences between LSEs and SMEs lies in the complexity of their transactions. LSEs engage in a wide range of complex transactions, including derivatives, foreign exchange, mergers and acquisitions, and more. LSEs also have to comply with more comprehensive and complex accounting standards due to their size and the nature of their operations. They need to fulfill the requirements of the full IFRS standards, which include complex measurements and disclosures not required for SMEs. These differences between SMEs and LSEs are not just in size and complexity, but also in the standards they follow. While SMEs can use the simplified IFRS for SMEs, LSEs must use the full IFRS standards, which are more comprehensive and detailed. In summary, LSEs are larger, more complex entities that operate on a wider scale, engage in more complex transactions, and follow more comprehensive accounting standards than SMEs. Having understood both SMEs and LSEs, let's now look at the exclusions in SME standards. Certain exclusions exist in SME standards. Let's discuss them. SME standards, while comprehensive, do not cover every aspect of financial reporting. There are certain areas that are intentionally excluded, often due to the smaller scale and less complex nature of SME operations. One such exclusion is earnings per share. This measure, while useful for larger entities, can be quite challenging for SMEs. It's not uncommon for SMEs to struggle with determining the fair or market value of their shares. This difficulty arises primarily due to the lack of a public market for their shares, which is often the case for smaller, privately held businesses. Another key exclusion is interim reporting under the International Accounting Standard 34 or IAS 34. This standard requires entities to produce interim financial reports at least semi-annually. However, given the smaller size of SMEs and the direct involvement of owners in operations and reporting, this requirement is often deemed unnecessary and thus excluded from SME standards. Next, let's consider segment reporting under IAS 08. This standard requires the disclosure of financial information about different business segments within an entity. It's particularly relevant for larger businesses, which often operate in multiple areas or markets. However, SMEs, being smaller entities, are often focused on a single operation or market. This eliminates the need for segment reporting, and hence it is excluded from SME standards. Lastly, we have the exclusion of asset held for sale under IFRS 05. This standard deals with the classification, measurement, and presentation of assets held for sale. Large entities are more likely to engage in activities related to assets held for sale, such as the disposal of a business segment or the sale of a significant piece of property. On the other hand, SMEs typically do not participate in such activities. As a result, they don't engage in the complex transactions that this standard addresses, leading to its exclusion from SME standards. So what's the takeaway from all this? These exclusions reflect the unique nature and needs of SMEs. They demonstrate the recognition that not all standards applicable to larger entities are relevant or practical for SMEs. This understanding helps to ensure that the financial reporting requirements for SMEs are not overly burdensome or complex, allowing SMEs to focus on their operations and growth. These exclusions play a significant role in differentiating SMEs from LSEs. As we come towards the end of our discussion, let's summarize what we've learned today. We've journeyed through the distinct landscapes of large-sized entities and small-sized entities, exploring the many ways they differ and the impacts these differences have on accounting practices. We began by defining SMEs, those small, often family-run businesses that form the backbone of many economies. They have limited financial reserves, smaller revenues and expenses, and typically employ fewer people than large entities. SMEs also tend to engage in less complex transactions, a fact that becomes important when we consider the exclusions in SME standards. Speaking of exclusions, we then moved on to the unique standards set for SMEs in the world of accounting. We highlighted some of the key exclusions that simplify the accounting process for these smaller entities. Earnings per share, often a complex measure for SMEs, is one such exclusion. interim reporting under IAS 34, a standard that may be overwhelming for the smaller scale and direct owner involvement of SMEs, is also omitted. Similarly, segment reporting under IAS 08, which is more relevant to larger businesses with multiple operational segments, is not required for SMEs who usually focus on a single operation. Lastly, we touched on the exclusion of assets held for sale under IFRS 05, a standard more applicable to larger companies who engage in activities related to assets held for sale, while SMEs usually do not. In essence, the world of accounting is tailored to accommodate the vast spectrum of businesses that exist, from the small family-run firms to the large multinational corporations, each with their unique needs and complexities. The distinctions between SMEs and LSEs and the exclusions in SME standards are testament to this fact. Thank you for joining us today. Remember, understanding these differences can significantly enhance your accounting skills. Until next time, happy accounting.